Hello, today we're talking about cap rates. What is a cap rate? I have a lot of investors and even brokers that don't know what a cap rate is. So we're going to try to dummy it down. We're going to try to bring it down to its simplest form today. And a cap rate in the simplest form is really the rate of return that you would get on a property, the anticipated rate of return for 1 year if you paid cash for the property. So for example, I pay $1 million for a piece of property. I pay cash for the property. I am expecting a 10% return or a 10 cap. I buy it at a 10 cap. That means that I am gonna get $100,000 a year, or I am anticipating getting $100,000 a year. So $100,000 divided by 0.1, or a 10 cap, is $1 million. That really is a cap rate. Now, we typically are not buying a property all cash. We're using leverage. We're getting debt, 75% loan to value, putting 25% down, 30, 40, 50% down, depending on what you as the investor does, or if you're a broker, you're representing a client, how much they put down. You take your gross scheduled income, you minus out your vacancy, you get your effective gross income. Effective gross income minus any expenses to the property gets you your NOI. So you take your NOI, that's the net you're gonna make before your debt. That divided by your NOI, divided by the purchase price, is your cap rate. So if we're leveraging the property, we then would minus from NOI our annual debt service. So we take the monthly payment, we times that by 12, we get our ADS, annual debt service. That minus our NOI gives us our net cash flow. So really our cash on cash return is gonna be whatever we get after we make our mortgage payment divided by the amount we put down. So if we have a 10 cap in this scenario, we're making $100,000. We put down $250,000 on a property, and after we make our mortgage payments, we're getting on $100,000. We make mortgage payments of, let's just say, $75,000 a year. That would be $25,000 that we're making on $250,000 investment, or a 10% cash on cash return. Typically, if your interest rate that you're borrowing at is lower than your cap, which it should be, then your cash on cash return should be slightly higher than the cap rate. In general, there are some exceptions to this rule depending on the amount of debt that's on the property. Cap rates are typically extracted from the market. So I don't know what the cap rates are. What you're gonna do is you're gonna research comparables. You're gonna look at what other properties sold. So for example, I've got a 20-unit apartment building. It has net income of $50,000. That's what its NOI is. And the property sells for $1 million. Well, that's a 5 cap. If we have $60,000 of NOI and we're buying something for $1 million, that's a 6 cap, and so on and so on. Typically, well, you want to buy at a high cap and you want to sell at a low cap. There's an inverse relationship there on your cap rate. But again, in its simplest form, a cap rate is the rate of return I would achieve, I anticipate to achieve over the next 12 months or 1 year time period if I paid cash for the property. It is really a ratio of NOI, net operating income, to the purchase price or the value of the property at that time. If you're an owner and you want to look at, hey, what are cap rates selling for, or what would my property be worth, you want to extrapolate out cap rates from the market look at what your current NOI is, and then that would effectively give you, once you divide that market cap rate into your current NOI, that should give you an estimate or an idea of what your value of your property is. So again, this has been Troy Muljat talking about Cap Rate 101, cap rates, dummy down, simplified cap rates. I hope you've enjoyed this video.